Welcome to this week's episode of the IBC Roundtable, where each Tuesday we are peeling back the proverbial onion on your favorite topic, that is the infinite banking concept. Russ, what do we have for him this week?
I think this is the episode where we're creating vision, clarity, if you will, Joey, because I think most of the time as parents, we lack vision because it was not passed down to us. We did not create a plan for our kids because we didn't have a plan created for us.
Exactly. How many of you have come to us over the years and said, man, knowing what I know now about infinite banking, how much farther would I be if my parents had started a policy on me when I was a baby?
If I had a policy started on me when I was a baby, that thing would have to be worth $1 million by now.
That thing would be ancient.
It would be so awesome, though. Can you imagine? We talk about how these policies over years constantly compounding, getting better and better as it gets older and older. Now, the use of that money, that's what I want to pass down to my kids. I want them to see how buying cars, paying for their college educations, preparing for their future is used through this process. And today's episode is one where we actually peel back the onion, as you said, and start showing that vision.
Absolutely. Let's get into this episode and belly up.
Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Murray.
Welcome into the Roundtable, the IBC Roundtable podcast. We are so glad to have you. I'm your host, Joey, the Italian Stallion Murray, joined, as always, by the smooth criminal, Mr. Russ, the idea guy. Morgan, Russ, how are you doing today?
Smooth criminal. I thought I got that thing off my record. What are you talking about?
You're smooth, man. I don't know where that came from. I just decided to throw that out there. But we're also joined by one of our coaches. You know him, downtown, Ernie Brown, the man of very few words, but they are strong to quite strong. Ernie, welcome.
Thank you, Joey. Good to be here with you guys.
All right. So, Russ, we need to get into today's topic. Today, we're talking about creating policies on our kids. Why in the world would we be talking about this?
Well, I think what we're really talking about is how do we prepare our kids for success? How do we launch our children into a position that maybe we were not set up for? At least I wasn't, right? Like I have a lot of great sayings. My dad loaded me up with
one-liners.
If you need one-liners, some of which you can say at a dinner table, most you cannot. That was the sort of success I was getting, right? It definitely didn't come financially motivated.
Well, I would say this is universal, though. We not necessarily the one-liner piece, but I'm saying like I've never like talked to a family, to a parent, and said, you know, would you love for your kids to be better off than you were? And them say, no, not really. No, it's like this inner motivation that we want them to have a leg up, like to be ahead of the game, because we want to pass our wisdom on to them.
Yeah.
You know, like, oh, what would I tell them 30 years ago? What would I tell myself 30 years ago? That's the kind of things that I feel like parents are all about.
It's like a Mercy Me song, Dear Younger Me, right?
Exactly.
And speaking of younger me, so Ernie, you've even talked about on this show, like I felt like your parents were trying to set you up. They were trying to put you on a path to success, because I remember you saying on this podcast that you actually had a financial advisor come in, sit down at the dinner table with you.
That's right.
And was trying to help you set up some accounts.
Yeah, no doubt. 100%. My parents wanted me to have better than they had. Who doesn't want that? And I definitely see that with my parents, and including financially. I mean, there were some financial lessons out there. I was always in debt to my dad is what it was. I was paying off a remote control boat, a drum set. I was washing the car, cutting the grass. I mean, anything. I was always paying him back for something.
But I think there's some benefit to that. I mean, I think when we have our children, we're trying to teach them lessons. But also, I think we also have to be careful as to how we teach, right? Because you just mentioned something, and one of the things, I think there's nothing wrong with hard work, and we want our kids to understand the value of production. and it doesn't come without sweat and labor sometimes. But also, what we would love to teach our children, at least from my perspective, and let me speak to it for everybody, is that I want them to use their minds to do it, right? Because one that could use their mind could get 100 people to do the job. I was listening to our podcast today, I think, Joey, that came out today, and you were talking about your daughter, Annie.
Yep.
And you mentioned how she had underestimated the market whenever she went out and said, hey, I will do watercolors. And she had 70 responses.
Yeah.
Right. My thought was, how do we teach Annie how to start teaching other kids how to do the artwork and pay them $20 and make $5 off the top of them, or pay them $20 and make $50 over the top of them. How do we start using our minds and helping our kids start to become creative in that way? And I think those are the ideas that I'm hoping that not only will be discussed here today, but also will be things that we can take home and apply. Because recently I bought a book. At least I think you can call it a book. It's since some of them come with matches in them, and they still call them books. I guess I can call this. But I bought for Joey and I, Rich Dad, Poor Dad for Teens, because I wanted to start that conversation. I didn't know I was buying the miniature version. So just FYI, when you go out to Amazon to buy Rich Dad, Poor Dad for Teens, go ahead and get you the paperback version. Just do yourself a favor, unless you need a copy that you can put in your pocket.
Or you're literally going to read the fine print.
Exactly.
Okay, literally.
Exactly. But I do think that, just starting here, because I wanted to start with, and you and I had that conversation, we wanted to start like educating our kids in their mindset. And we're going to actually start paying them for reading these books and doing reports on them, coming on and actually helping us build out a module inside the community where people can bring their kids to inspire their kids to do other things.
And by the way, this is not us speaking from like our own, ability to do this. We're trying to learn along with you how to pass these lessons down, because generational wealth is one thing. We've actually talked to Andrew Howell. We talked to Aaron Chapman, many people about the idea of a legacy being much, much bigger than actual dollars. Is the education. And that is a much harder thing to do. So Russ and I are in this journey right now trying to figure out, well, maybe this will work. Maybe if we get our daughters to read and then pass that on, now that's going to start to sink in, and then them do, like, hopefully that's something you'll learn along with us.
Well, I don't remember who told us this, but I love it. They said, if you're going to teach your kid how to surf, would you go put them in a college classroom with a professor? Or would you go to the beach, hire a surfer, and get them out in the water and teach them how to do it?
Exactly.
And I think that's what we're wanting to do. And I think we're going to start with getting them just activated, getting their minds activated by reading these books with us and paying them to do it, which there's a lot of benefits, and we can get in another conversation with our
I don't know. I mean, Robert Kiyosaki says have them do the work and not get paid.
Well,
so we may already have a discrepancy.
Well, by the way, do you guys know one of Robert Kiyosaki's first ways that he made money? Have you guys heard this?
Yeah, he literally made money. Like, he melted down metal and made coins out of it.
What?
Did you not read that?
No, I didn't read
He
that.
and his friend, they were, they got told later that was not legal, and they should not continue that practice, but they were physically making money.
Well, no, that's not. Well, that's news to me. And I'm not saying that's not true. One of the stories I heard is from he and one of his kid friends. They would go to the store, one of the stores that his rich dad owned, and they had these comic books.
Yeah.
And what they would do is all the ones that weren't read at the end of the week, they would just have to like tear the copy off of them, and then they could basically throw them away. Basically, the deal with, I guess, the distributor is that you'd have to like kind of deface it, so that way it couldn't be resold. But they didn't want them back, right? They didn't want the whole thing back. And so what he did is worked out a deal where he got to keep. He would just go and get all those out of the trash can. And as long as he didn't sell them, he was still within the law. So you know what he did, Ernie?
Probably rented them.
Exactly. He created a little library.
That's right.
He took all this. So he would charge kids, I don't know if it's like a nickel or 10 cents, to go in and just be able to sit in his like room and read all the books that they could read.
And then
That's
I think at one point he had his sister as a librarian, right? Like,
well, these are just great things. And we're obviously the whole point of the podcast, this roundtable, is to discuss how we're using life insurance policies and how then these concepts, these different ideas that we have play into that. And so as we're thinking about kids, there's one thing that we've talked about is how do we use life insurance policies in our kids' lives to teach them well? And I've got something coming up personally. So I haven't done this yet, but I will be doing this soon. And I have a daughter who's turning 15 on Monday, I believe it is, which is crazy to me.
by the way, you need to get working on that present if it's already coming up.
Remember, I told you I already have somebody that's totally efficient on Amazon. That is taken care of. I'm great at delegation. Well, obviously, we're going to have the need for a car in the next 12 months. And I've decided that I will probably be buying her a car sometime in December, because I would rather her be using that car for 5 or 6 months prior to her driving it. Because I've seen the statistics of when a kid turns 16, the likelihood they will have an accident in the first 12 months are like through the roof. And I was one of those who definitely was a part of that statistic. And so I want to go ahead and get her acclimated to the car. Because a lot of times I think one of the reasons why they get in an accident is that they get this brand new car when they're 16, and now they're driving something they're not familiar with. They don't understand everything. And so just the newness of it can be overwhelming in addition to everything else.
Yep, good call.
So one of the ways that I'm going to help teach Alexandria about what we have is I'm going to take a policy loan to buy this car. Now, we've been on this podcast before, Ernie, and we've talked about, and have been asked several times, should I take a policy loan at, say, 5% and buy a car, or should I get a car loan at 1.9%? And a lot of times, what is our response to that?
The math would say, let's go get it externally.
Yeah, because if we can borrow the money at 1.99, then that money that if we don't use the insurance company's money could be used to do something at a higher rate, right? And I agree with that 100%. Actually, every car I've bought for the last, 5 or 6 years, I've done that way because the math would tell me it would be better. Now, in this, Joey, though, when we get to December and I buy the car for Alexandria, I am not going to borrow money from a bank, regardless of what the interest rate is. I'm going to borrow the money from the insurance company. I'm going to use her policies to do it. Why do you think I'm going to do it that way?
Well, because now that's her surfing, right? You're giving her the surfboard and teaching her how to use it, because the policy is just like, that's the means to her purchasing this. Now she can start to pay it back and see how this whole thing works.
Right. When she can physically see this is an account that has her name on it.
Yeah,
right.
Exactly.
This in theory is hers. Now she's going to have to show responsibility before I would ever give it to her. Just like anything, you're going to have responsibility. What responsibility is going to look like, we're going to define that. But at some point, if you can demonstrate that level of responsibility later in life, I'm going to give you this instrument, which is going to be a pretty wealthy thing, right? So I want to start showing her how to just think about it, it's like a new dog, right? You got to feed it, you got to clean it, you got to do all of these things.
Take it out.
Yeah, you've got to be responsible for it. And so I want to do the same exact thing when we buy this car. And she can physically see it. Now, could she do it somewhere else? Yes. But whose money is more valuable, yours or someone else's?
Yours.
Yeah. And she's going to take a lot more ownership, at least that is my opinion, of something that she values and sees as her own.
So that's awesome, Russ. I appreciate you sharing that, because we need more ideas to pass along this wisdom to our kids. And I think this is something, again, if you have ideas and you're listening to this, you want to share those in the community, please join in. Our inner circle is available for you to join at any time. You can just go to wealthwithoutwallstreet.com/inner circle, and you'll have access to tons more stuff. But the bigger thing is the community, to be able to add your feedback into this and to also learn from others. We're about to jump into a hot seat with some of our inner circle members that you'll be a part of, to be able to ask them questions, things like that. But one other thing I want to add, Ernie, you're talking to people more on a daily basis about some of these topics, and especially how they're starting policies. What are their goals for starting policies for their kids? What's some of the things you've heard recently?
Well, there's a lot of reasons that you would start a policy, a lot of motivations for the parents to start a policy. One of them could be just, it's the next best place to buy a policy. They've been buying policies on themselves. Why not look to their kids? Can we insure them? Another one is just looking to start to save for college, start to look for that car. We're going to start preparing for that and having practiced on themselves. It's a no-brainer for them at that point to start one on their kids for that purpose. But another one, I want to talk about this guy who we are in the middle of underwriting on. For him personally, he is just a couple years older than I am. He's recently married like I am. Both of his parents, his parents and his spouse's parents, both started policies on them when they were kids. Granted,
Wow.
they weren't created like we would create them, but they're whole life policies nonetheless. And he's turning the page, taking some responsibility, wants to start doing some investing. He's got these policies now that the parents turned over to them when they got married. That's got significant cash value. Again, not because they're created by like we would do them, but just because of their age. And now he's got the place to launch investing. And he's so excited about that. And it was very easy for us to connect how we use these policies as a financing tool for him personally. And now he's expanding on himself. It's just really cool, that tool that exists for him today that's 12, 20, 18 years old, forget how old it is at this point. I think that's so cool.
That is really cool. I want to actually bring up a question that we hear a lot, or I have over the years, is, and I want to get your thoughts on this, Russ. People typically, when they start thinking about life insurance, and let's say they want to go down this path of infinite banking and getting started, a lot of times I have heard, well, wouldn't it be better for me to start this policy on my kids? Why do you think that is? And what would be, some feedback on that?
Yeah, I think the early part, right, is that we hear about this concept of buying an insurance policy, and our brain goes into what we've known or have learned about insurance, is that the older we are, the more expensive insurance is, right? So we automatically, when we think, oh, this is the best way to do it, then we immediately say, well, I'm clearly, regardless of how old I am more expensive than my kids would be.
Right.
And the natural thought would be, well, why don't we just start policies on our kids? And that's a really good idea, but there's some hiccups in that, isn't there? Ernie, just share some of the problems that exist when buying policies just on kids without buying policies on yourself.
Yeah, well, we had this one guy recently. He's up in the Northeast somewhere. He's been investing in passive income and has never bought insurance. He sees this opportunity for his kids now, same line of thinking. And he was, let's go forward. Like, that's a great idea, but we got to start on you. And I wish we had started 10 years ago because he's uninsurable. So number one, he can't get coverage on himself. But if we were to take applications for some kids policies and we don't have coverage on the parents, the insurance company's not going to allow that. They're going to base how much coverage we can have on kids based on how much coverage you have on yourself first.
Now that's an interesting thing that you just don't think about that. We think that we can always buy, not only on ourselves, we're always going to be, that He-Man, right? We get this image of ourselves. When you walk by the mirror and you're like, still got it, right? You just don't realize that mirror just laughs at you when you walk away, right? We're not as invincible as we think, but then we don't realize that the insurance companies, their whole objective is to insure risk, right? They're looking at it from a financial perspective. So if we don't have insurance on ourselves, but we want to insure our kids, that's going to throw a red flag up. And I know that us as parents are like, what's the problem? But unfortunately, people who don't buy insurance on themselves don't see the importance of protecting their kids if they were to die, right? I mean, because the best thing I can do for my kids is to leave them in a better position if I'm not here than if I'm here, right? So if I'm not willing to do that on me, why would I want to buy it on the kids again? That's the kind of logic the insurance company is going to use, and they're going to say no. So we are limited to being able to buy policies on our kids based upon our own insurance or our spouse's coverage.
Yeah, that's a good point. And I wanted to point that out because I feel like that's a common thought that we have. It's totally logical when you start thinking about buying insurance and premiums and costs and so on and so forth. But we have to see the bigger picture. And I think that's actually, something I feel like maybe standing in the way is the vision of what we're trying to accomplish can sometimes get a little hazy when we're talking about infinite banking, and we can start to think kind of segmented. But talk to us a little bit, Russ, about vision as it relates to this whole concept and implementing it at this generational level.
Well, I think the things that we get a chance to do is to implement something that can last forever. I mean, I just remember just talking with Nelson Nash, the author of the book, Becoming Your Own Banker, and he would say, Russ, there's 3 things that you have to do. Now, he added those 3 things as time went on. But the very first thing that he would tell us, Ernie, is that you've got to think long range. He would say, I was trained as a forester. I think 50 years into the future. Now, a lot of the people as a forester that I was helping, we're not going to be there 50 years. But when in the forestry business, when you're helping tree farmers, that's what you think. You've got to think 50 years in the future. So they're planting trees. And there's people out there that are in that industry that think into the future. And he said, you got to think that way too, Russ. And when he started building this system in his life, he was in his early 50s. And when he died in his late 80s, he had, I remember we all got a chance to see this diagram of the amount of insurance policies that had been bought on all the generations going down. And you really got to see what generational wealth would look like, how you not only just gave money, but more importantly, gave the knowledge in the toolkit, the manual to follow with that. And for me, that's vision. Yeah. When I want to prepare our family, I want to think about what that looks like. I know here in the winter, you and I are going to head over to Salt Lake City. You mentioned Andrew Howell a second ago, the author of Entrusted. He has a law firm over there that really focuses on creating vision for your family, implementing family trust as a way to pass down some of those values, some of the vision that we would have for our family, what we would want. That's what I think about.
Yeah, and there's a really good reason why we're waiting until the winter, because it's in Salt Lake City, Utah. And there's no better time to go than in the winter. So might as well do 2 things at once.
I would definitely do at least one of those things.
But I think it is valuable to have, in this sense, we're hiring somebody that has a specialty of helping us get that vision put in front of our families. Because we could try to do it, but at the end of the day, they've got a proven system and way to help us get to that point.
Well, do you feel like, though, sometimes the question mark is, that's great. I have this vision, Russ. You're always coming up with ideas. Half of them are harebrained, and I'm sure you don't follow through on them. That could be the thought that you're having, and it could be valid. Maybe I don't have these visions. Maybe I don't have these ideas. How do I do that? Do you think that's a question people might have, Ernie?
Yeah, absolutely. Just the lack of what's the next best step for me, especially as it relates with IBC. We have those conversations all the time. What should I do? What's the next best step? I think that's one thing. Another thing, though, is, you can have those moments of clarity where you can think, what's the next best thing? But that's making an assumption that you're thinking about those things. Day-to-day live calls. See you guys constantly moving on to the next thing. You guys are constantly working on projects. So I think we just get busy. And so if we are thinking about those things, it's because we've got a gap in all the things we're doing when we're not thinking about this.
Well, and I would say another issue that I think is very common is the tools that we have historically been programmed to use do not lend themselves to generational wealth and having a vision for your family, like 401ks, IRAs, things about those are not teachable assets. Those are things that we put money in. They're really just to perform the function of our own personal retirement. So they're very self-focused. They're very internal. And so they're not things that we're passing along. I mean, even our CPA has said they're some of the least efficient legacy vehicles that exist, because from a tax standpoint, they just get hammered in the passing from one generation to the next.
That's intentional.
Yeah.
I mean, that's not just a coincidence. That's intentional, but it's easy, right? I mean, we get focused. I mean, Joey, it wasn't but a year and a half ago or so that you bought your first policies on the kids.
Yeah. I mean, you would think that I would have gotten it like right out of the gate. And to be honest, I was just too focused in on just growing my own personal policies and also looking for ways to expand my own income. You know, I did have to start a business from scratch in the middle of my career, leaving a $300,000 job to do this. So I had a little bit of a hiccup on the cash flow. But yeah, to your point, you know, that's an issue. The other thing I've seen is that sometimes we just have to have our eyes open to what's right in front of us. Just like in the last year, I had a client that reached out to me, and he was open to the idea of funding kids' policies. He really wanted to, but he couldn't see how it was possible. And it wasn't like I was like, you know, dissecting his cash flows or anything like that. But he just started mentioning some things, like he's a real estate investor, and he had some cash flows coming in that he was setting aside for maintenance for those properties that he was
like
managing.
A reserve or something?
Yeah, like a reserve for, you know, if the HVAC goes out or whatever. And they were pretty significant. And as we were talking, he actually brought up to me, he's like, well, why wouldn't I just use those cash flows to fund my daughter's policies? He had 2 daughters, and then use that to fund those issues that may come up in terms of my rentals. And I was like, you could absolutely do that. And so anyways, it was kind of like once he started thinking differently, it started to appear, and now he's got his kids insured for life.
Well, that's a great example. And I know we're getting ready to switch over to our panelists for today. And as Joey said earlier, if you're not a member of our inner circle, you have an opportunity. You go to wealthwithoutwallstreet.com/inner circle and join, because that way you won't miss the second part of this conversation and ones in the future, where we really dive into the nuts and bolts and what people are actually doing outside of just us. But I do think about that, Joey, that the opportunities that we have of what to put money, because a lot of times people start policies on their kids because they're thinking about college. And if they are really planning in advance, they start them when their kids are young. And that's a number of years in which money's just going to be sitting idle. And so they start thinking, well, what else could I do with those dollars between now and then? Because we just had a guest on our show, Bill Allen, 7-Figure Flipping, and he talked about he had started one of those 529 plans, and he put $50,000 in, and after 3 years, it had $53,000. He has a 7-figure home flipping business, and he was like,
wait a minute.
but he thought in his head, well, that's my work. That's not my kids' college, right? My kids' college is this thing that's set up just for kids' college. 529.
Yep,
and he thought,
compartmentalizing that.
he said, well, if I would have had that 50,000 in my business, and in 3 years, I would have quadrupled it. And that's where we know that about the way these policies are designed, because they're liquid, they give us accessibility. It does not prevent us from taking those dollars and using them. And if we use them in that way, can we not get to our kids' college goals faster and even maybe more risk-free? And also be an educational tool along the way. Because as you said, 529s nor 401ks are educational tools.
No, not in the least.
Not unless you want to show them how it goes up and goes down. That's the only education that's going to happen on it. But we're going to move over. We want to hear from you, our panel, because you're experiencing this, you're going through this. So as we end the show today, I encourage you to be a part of our inner circle. I thank you, Ernie, for jumping on the podcast again with us today. Joey, thanks for your input, and thank you for listening. We'll see you next time on the Roundtable.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand, so that your wealth will never run dry.